We are joined now by Andrew Moffs of Vision Capital, taking your questions on real estate stocks. Andrew, it's great to talk to you. Thanks very much for coming on the show.
Thanks so much for having me on.
Let's get to it. We have an email from Jeff. Jeff wants to know about Minto Apartment REIT. Could I get your perspective? Why has it not performed better in the context where rental housing is so scarce?
So Minto is an apartment landlord in Canada, concentration in Ontario, particularly in Ottawa, and they have expanded out west in Alberta and out east in Montreal, as well as they're trying to break into Vancouver. Great portfolio. So surprising if you look at this stock, it actually trades below its IPO price, notwithstanding solid management, good assets. So the question is why? Up until now, they've had a best-in-class portfolio, but they not necessarily have had a best-in-class balance sheet. As a result, despite, on the top line, you're seeing the growth, it's not falling down to the bottom line. And why was that? They had too much leverage, perhaps, but more so too much variable rate interest rate exposure. Looking ahead, they're looking to solve that, sell assets in order to reduce that leverage and give them the capacity to grow into British Columbia, Vancouver market, where there's some attractive developments where their parent company is currently developing and they could buy into. So long story short, I think the trouble is behind them in terms of the translation between top line to bottom line, and a bit of a show me story in terms of execution. If they can sell assets in 2024, I think the stock will be set up nicely for, like I said, a high quality portfolio and good management.
We have Lisa sending us an email, wants to know about Innovalis REIT. What's your opinion of Innovalis? And remind us what they do, if you would, Andrew.
Yeah, Innovalis, that's been a very difficult stock to own. What they do is own commercial real estate in Europe. They're listed on the Toronto Stock Exchange. And if you were to look at a stock chart, this stock has really suffered. It's, notwithstanding the fact that the office market is a very difficult market to operate in, I just think they didn't have the right strategy going into it, perhaps not owning primary assets, owning more secondary assets or secondary markets in France, et cetera. They have cut their distribution. It's really a difficult stock to own going forward. So unless you have a very high risk tolerance, it's not a name I'd look to add to.
And sorry, what is the problem at Innovalis again?
They had some tenant churn in terms of move out and not being able to backfill those tenants. Rents came down at a time where interest costs were going higher and they could not sustain their distribution any longer.
Okay, we have Paul sending us an email, wants to know, getting a lot of residential REIT questions. Paul wants to know about Tricon Residential, TCM. That one down about 7% in the past year.
Yeah, Tricon's a favored name for us. They operate in the single-family rental housing sector in the United States with a focus on the U.S. Sunbelt. That's an area of the country that continues to see population growth. Tricon, the stock hasn't performed as well as the operations have, namely because, again, here they've had exposure to variable rate interest and higher interest costs, which have really muted their earnings growth. Looking ahead, I think they've solved that. They're on a process now to raise a joint venture, their third joint venture fund, where they put in some capital, but high quality institutional investors like pensions put in the majority of the capital, where they don't have to come up with a big equity check. They can leverage their expertise and earn management fees on other people's capital and go out and really do what they do best, buy homes and professionally manage them and rent it out to preferred renters. They currently operate with what we call a 15% mark-to-market. What I mean by mark-to-market is their rents are here, market is up here. So as tenants leave, they have internal rent growth of 15%. So I think that's quite attractive. It's simply been the balance sheet up until this point that has caused it to underperform. And I think some of those headwinds are behind them. So I think this is a good setup and a good stock to own heading into 2024.
Scott sent us an email, wants to know about True North Commercial REIT, and remind us what they're all about, please, Andrew.
Sure. So True North Commercial, not too dissimilar from Innovalis, is one of those names that have really suffered because of its exposure to the commercial office space. True North operates in Canada, majority of their portfolio, I believe, being in Ontario. Again, more secondary markets. Whereas in the past, they benefited from steady rental rates. No problem. Steady rental rates from government tenants. What they're finding today is it is much tougher, just like any landlord in the office space, doing blocking and tackling. As you lose a tenant, it's much harder to backfill and definitely much more expensive to backfill. This stock has seen a 5 3/4 consolidation.
Yes.
And they have suspended their distribution entirely with the idea that they can retain that cash flow and go ahead and buy back stock. Any office REIT that's focused on non-core markets, suburban markets, is not going to be in favor today. And I think it's an uphill battle owning this stock currently.
Andrew, I kind of exclaimed there because I looked at the pop on the stock, and of course our chart was not reflecting the consolidation, the rollback of the units. Thank you very much indeed. Andrew Moffs is our guest. He's with Vision Capital, and he's taking your questions on real estate stocks. We have an email from Richard. Richard is curious about another REIT that's had some troubles, Northwest Healthcare Properties. They've cut their distribution as well. Andrew, what's your take?
Yeah, I'm getting all the fun ones. Northwest, that's a stock that's been in a state of flux. Their founder, CEO has left, and the company has been going through a process of strategic alternatives. Can they either sell the REIT? Can they sell individual assets? Can they come up with a longer-term restructuring plan? This has always been a REIT with multiple balls in the air, so to speak. They operate across different geographies with slightly different property types, mainly a focus on medical office and hospitals globally: Australia, Europe, US, and Canada, Brazil. It's a very difficult market to sell assets into, particularly when you are a distressed seller. And when you come at it at a time where you have high leverage, in this case over 10 times debt to EBITDA, I think it's going to be difficult to come up with an optimal strategy. But I think they do have enough levers to pull where they can perhaps sell assets in the market and pay down some debt and come up with a better strategy in a better market going forward. It's a show me story, and hence not one we typically recommend when you have this much execution risk where they have to sell assets, fix a balance sheet in a difficult market, and hence it's not a stock we'd be looking to own today.
Tony is calling from Calgary. Go ahead, Tony, and thanks for calling.
Yeah, Andrew, I'd like to ask you about the apartment REITs. I have some positions in Minto, Interrent, and BSR REIT. I want to ask you about Moorgard Residential REIT. What do you think about that one in there? Thanks.
Thanks. Moorgard REIT.
Yeah, so Moorgard REIT, the ticker is MRG-U. This is a REIT that owns apartments on both sides of the border. So some of those examples that were given were either solely Canadian focused or solely US focused. Moorgard owns a blend of both. And I think around 12,000 units or so across their portfolio. The parent company is Moorgard Corporation, which owns an effective, I think, 45% interest in the REIT. The stock has always traded at a discount to net asset value. So that is always a good starting point when you're looking to invest in a stock, is if it trades at a discount to its intrinsic value. And that's partly because it is externally managed by a parent company, and hence control is not necessarily in the market, it's dictated by its parent. They have a nice portfolio here in Toronto and Mississauga, and they've done a great job of recycling their assets in the United States. Overall, the stock trades at quite a wide discount to net asset value and probably in a high 7% implied cap rate. That's the going-in yield for the asset, the inverse of a multiple. So if you own it today, I'd feel comfortable in terms of holding on to it. Are there better ideas in the residential space? For sure. But I think you have a nice distribution yield, probably around 5.5%, trading at quite a wide discount to NAV. I think you're okay holding on to the stock today.
Len is on the line from Etobicoke, Ontario. Go ahead, Len.
Hi, I would like to know about Smart REIT. I was reading an article about there might be a possible cut to their distribution.
Smart REIT.
Yeah, so Smart REIT is a REIT that owns predominantly outdoor open-air centers, shopping centers across Canada. I say predominantly because they've done a great job of expanding into some other asset types, i.e. going vertical on some of their land, building condos and rental towers, as well as expanding into self-storage, for example. But at the end of the day, their net operating income is dictated by retail and specifically by their largest anchor tenant, Walmart. So by definition, when Walmart is your largest tenant, you're going to have a very defensive profile. Hence, I never worry about the income per se at Smart REIT. The flip side is you have very little growth. So this is very bond-like in terms of the ability to grow the top line. The question about the distribution is, what we've seen is their cash flow coverage has been tight in terms of how much they pay out to unit holders versus how much they retain. And whereas in the past, they've had some nice condo gains where they've been able to offset and give themselves some room, that might tail off going into next year. I'm not necessarily worried about their distribution. I believe they are committed to it and will sustain it, notwithstanding the fact that their payout ratio had been over 100%. Today it's below that, and hence I'm less concerned about them cutting their distribution. If you're looking for growth, there are different names in the retail space in Canada where you can find greater earnings growth looking ahead.
A yield of about 8% on smart centers. Is that high?
Yes, definitely. That is a high yield, and hence usually that means you're not going to see a lot of price growth. On a total return basis, the majority of your return is going to come from that yield.
Okay. We've got Larry on the line from Waterloo, Ontario. Go ahead, Larry. I don't know if we lost Larry. H&R REIT was the question.
Okay. So H&R REIT is a diversified REIT that's doing its best to diversify away from other sectors into predominantly residential multifamily apartments in the United States, in the U.S. Sunbelt. They continue to, as well, to own a very high quality industrial warehouse platform, and they're doing their best to move away from the legacy office buildings that they continue to own, as well as find densification opportunities within that portfolio where perhaps a higher and better use of an office building in downtown Toronto is residential. This is an execution story. They continue to execute, but it has become a much more difficult environment to go through that process of entitling land, looking to sell it. We've seen land prices really fall across Canada and the United States. So that prospect is perhaps less exciting, notwithstanding the fact it will be great proceeds to the company as they look to repatriate that capital and put it into multifamily in the United States. The multifamily market in the United States has become a little tougher in the past year. There's a lot of new supply across the United States in terms of new apartments being built, and hence operating income will slow down for H&R going forward. I think this REIT is in that hold bucket. It trades at a discount to NAV, but a lot of headwinds in terms of the fundamentals as I described.
We are going to take a quick break. When we return, we'll have a look at Andrew's past picks. You're watching Market Call. Andrew Moffs taking your questions on real estate stocks and REITs. Andrew was on our show November 29th of last year. His first idea was First Capital REIT, FCR.UN. Let's see how this one did. Down over the period. Just remind us what they're all about, Andrew. Tell us why the units have slipped.
Sure. First Capital REIT is the preeminent owner of shopping centers, grocery-anchored, necessity-based shopping centers across Canada. We believe this company has the best portfolio, highest quality portfolio globally in terms of grocery-anchored shopping centers. Think top grocers, top pharmacies, and you can't buy this type of retail online, you need to go into the store to do that. You can't get your haircut online, for example. They own over 20 million square feet, plus an additional over 20 million square feet of density, meaning when we talk about the valuation of this REIT, you're getting all that density for free. It trades at a 40% discount to their published net asset value. That is pretty cheap in our opinion, especially for such high quality assets. The stock was the subject of activism, hence the stock, if you look at a stock chart, it did quite well. It was actually up 10% from where we recommended it last year. And then subsequently, the stock has sold off with the market, but at the same time, one of the activists has been a known seller of the stock, and that put a bit of an overhang on the stock. Looking ahead, we look at this and say, here's a great opportunity to buy defensive real estate at a very wide discount to net asset value, where at a time where the fundamentals are great, couldn't be better. So we think this is a stock you want to continue to own.
Your next idea was Sun Communities, which is a big player in the so-called manufactured homes business, multiple U.S. states, a lot of them in the South, but I see they're in New Hampshire and Michigan as well.
Yeah, typically you find manufactured housing communities, the concentration you'll find in Florida as well as California, but they do serve some all-age communities in more of the middle of the country. Sun Communities is one of the preeminent owners of this type of real estate. We think it's a great type of real estate to own, and the market has always rewarded this type of real estate. It's really a land business where someone else comes and parks their house on your land and pays you rent and pays all the operating costs. Very pure form of cash flow. As a result, the sector is always traded at a premium to net asset value, and in very few circumstances has it traded at a discount, and today is one of those circumstances. We think Sun is a great stock to own. It has underperformed. Why? They did expand into the United Kingdom 2 years ago, and perhaps that acquisition came at the wrong time in the market. And right now, it's about 5% of their business in terms of UK home sales, but the market is so overly obsessed with this business that has underperformed and neglecting the 95% of the business that is very dependable and recession resilient. I think they're going to show something like 5.4% rent increases next year. So we think a great opportunity to own a company trading at a discount to net asset value when you should focus on the FFO growth for next year.
And finally, Dream Industrial REIT, DIR, are they about warehouses for e-commerce, Andrew?
Indeed. Warehouses in Canada and Europe, as well as a fund that they own that invests in warehouses in the United States. This landlord trades at one of the widest discounts to the private market value of its real estate globally. The stock has done well. It did even better earlier on in the year when I think it went over $15. We think it's worth north of $18. This company is going to have the highest adjusted funds from operations, basically cash flow growth, CAGR, over the next 5 years of any REIT globally. We think 9% is what we estimate, and the setup is quite good. E-commerce is not going anywhere. It's going to continue to increase as a percentage of retail sales, but in addition, you're seeing the dynamics of onshoring and reshoring, which is really modernizing the whole supply chain, and some of these decisions are multi-decade decisions where we think the demand is going to overwhelm supply in industrial warehouse, and Dream Industrial is well positioned to take advantage of that dynamic.
Okay, we are going to take a break. Andrew Moffs is our guest, talking real estate stocks and REITs. 1-855-326-6266. We have Mike on the line from Toronto. Go ahead, Mike, please.
I've been watching Slate Grocery REIT and the dividends and the talk about the dividends being cut. So I've been slowly bleeding off
I've sold off about 80% of my stock, but do I continue, or is there hope for the dividend?
Slate REIT.
So, yeah, Slate Grocery REIT focuses on grocery-anchored shopping centers in the secondary markets in the United States. A strategy that I think is a good strategy. The issue, of course, is what the caller has alluded to, is the overpayment of their distribution currently. Hence, the stock trades at a very high distribution yield. I'm not sure it's sustainable. Unfortunately, interest costs are really cutting into the bottom line for everybody, and those with higher leverage even more so. At the same time, their top line has been a bit muted. They're not, I think, only about 0.5% growth this past quarter. And as a result, any capital that the REIT has retained, they're actually going towards buying back stock as opposed to paying down debt. So I think the setup is going to be a bit more challenging going forward. I think there's better opportunities if you're looking for defensive investments in the retail space, and that's why I could point to a name what we talked about earlier, First Capital REIT as a good alternative. You're not going to have as high a distribution yield, but I care more about the total return going forward. And right now, any REIT that's over distributing will have a challenge in terms of a total return potential overall.
Yield of about 11%. They're all about U.S. grocery anchored real estate. Did they just leverage up too much? Was that the problem, Andrew?
Yeah, this REIT had operated at higher leverage levels. So today that's about 60% loan to value. That gets more challenging as, arguably shopping centers, all real estate, the price has come down. So your denominator is going lower, your leverage is staying the same. And so every time a loan comes up for maturity, you're going to have to pay more for it. You're on this treadmill of cash flow going lower.
Okay. We have Bob calling from Uxbridge, Ontario. Go ahead, Bob, please.
Thank you for taking my call.
Pleasure.
Can I have your guest's opinion on Main Street equity? Any comments he has on it would be appreciated. Thank you.
Thank you. Main Street.
Yeah, I think highly of Main Street and Bob Dillon, the CEO and founder of that company. It's not a REIT. It doesn't pay a dividend. It is a great example of the ability in real estate where if you have the right balance sheet and you don't have to pay out your cash flow and you retain it and reinvest it in your properties and accretively go out and buy more properties, you're going to build a great business. And I think Main Street has done that. They focus on apartments in Alberta and British Columbia and growing into Winnipeg, and it trades at a discount to net asset value. So with population migration, population growth coming in, population growth in Canada increasing, and you're seeing population migration into Alberta, I think this is a great story. And so it's a stock I would continue to own and look to buy if there's any type of pullback in it.
We've got Ed on the line from London, Ontario. Ed, fire ahead, please.
Yeah, thanks for taking my call. Yeah, so wanting to get the gentleman's opinion on Allied Properties, and if it was $30, now it's $17, and it's dividend safe. Thank you.
Thanks.
So Allied focuses on the office market in Canada. A nice portfolio in Toronto and Montreal, and assets in Vancouver and Calgary as well. And I'd say about 80% of value being in Toronto and Montreal. They are good operators, operating in a very difficult market. It seems to be a consistent theme anytime someone talks to me about office. The stock has suffered, and at this point, it arguably trades at a discount to net asset value. I think the public market has done a very good job of discounting what's going to happen in the private market. As we always know, the private market is much slower in real estate to catch up because you typically have leases in place. Looking ahead, Allied is committed to its distribution. It's about a 10 yield currently. If they execute on the business plan that they've outlined for the rest of this year, and more importantly into 2024, that distribution will be sustained. And where they helped themselves was the sale of their urban data center portfolio earlier this year. So that really gave them some breathing room in terms of both commitments to their development pipeline that they had to pay, as well as their balance sheet and paying down debt and giving them breathing room on things like the distribution. So they do have income coming online from developments that are soon to complete. So I do believe the distribution is in a good spot for next year.
Thanks very much for that question. Andrew in Calgary, go ahead, please.
Hi, can I get your guest's comments on Granite, and does he own it? And can you compare it to Dream Industrial? Thank you.
Thanks.
So Granite Industrial focuses on warehouse real estate in Canada, Europe, and the United States. So very similar in footprint to Dream Industrial. Dream Industrial is probably lighter in the United States, given they've sold their portfolio into a fund and simply manage it and have a small equity slice today. Granite traditionally has had high concentration to Magna, the auto parts maker, and they've done a very good job of bringing down that exposure. Not necessarily that's a bad thing, but typically the market doesn't like to see tenant concentration in any one tenant. I believe they have a very solid management team, really have shown themselves to execute well through any part of the real estate cycle. The stock has been an attractive stock previously when fundamentals were going in one direction for industrial real estate. I think today they have some more exposure relative to a REIT like Dream Industrial in the Midwest, where some are worried about new construction and high amounts of new supply coming into the market, and hence you're seeing some muted rent growth. Notwithstanding the fact that Granite will have nice mark-to-markets in rent, they will not necessarily see future rent growth in some of those markets from here. If I had to choose between the two, which I have, we own Dream Industrial. Currently, Granite continues to be a great option as well for those looking for industrial exposure. So between the two, if I had to choose, it would be Dream Industrial, but I would also own Granite as well. It's been a stock we've owned in our fund.
Okay, we're going to be back with Andrew Moffs, taking your questions on real estate stocks and REITs. Glenn is on the line from Winnipeg. Go ahead, Glenn.
Hi, guys. I was going to ask about Artis REIT. I know their office component has hurt them, just like all the other office REITs, although I don't believe office is that big of a component of their holdings. Interest rates also, but I kind of feel that we've topped out on interest rates. So, yeah, I'm just wondering what you think. Might not see interest rate cuts till fall, so maybe this is a little bit premature. I was also going to ask for a comparison between Artis and H&R. I heard what you'd said about H&R earlier, so I'm just wondering, what you think about Artis, and of those two, if you had a preference or possibly neither. I'll hang up and listen to what you have to say.
Thanks.
Well, I'll start with the latter question. If I were to choose between the two, I would own H&R over Artis. Unfortunately, Artis is in the midst of trying to figure out what the right strategy is for the REIT. It is externally managed effectively by another group who was on a quest to sell assets to reinvest in publicly traded real estate stocks. And that strategy is now uncertain. And in August of 2023, they announced the formation of a strategic review for the REIT to unlock value for unit holders. The outcome of that is uncertain. And like I've talked about previously, this is a very challenging market to be selling non-trophy type real estate. Up until now, Artis has sold the things that they could sell, and they sold some high quality portfolios, whether it be industrial or higher quality office buildings. Today, it's a question of what could they get for being the largest landlord in Madison, Wisconsin office. And notwithstanding the fact they do have some good assets, for example, in Winnipeg as well as in industrial in Houston. So it is a show me execution story in the hands of the Board of Trustees right now to decide what is the right path going forward. How can they create and salvage value for unit holders who have seen the unit price drift lower and lower and farther away from their stated IFRS net asset value. So show me story that you have to really believe in and be tolerant of a higher risk here.
We have Peter on the line from Oakville, Ontario. Go ahead, Peter, please. Don't know if I'm hearing Peter. Boston Properties.
Boston Properties is a very high-quality landlord in the United States, owning office buildings in markets such as Washington, D.C., Boston, San Francisco, New York, and with a smaller concentration in Southern California. They are a very good operator, as I mentioned, and trading at a discount to net asset value, not unlike all office REITs currently. They are better positioned than others. I think the trend in office that you will see going forward is those with either more modern buildings, more amenitized buildings built circa 2010 and to the present will outperform more commodity B space going forward. And so if you were to look at the vacancy levels across some of those better office buildings, they're probably more in that 5 to 10% range, whereas everything else is in the 20 to 30% range. So for Boston Properties, the story is about taking share, not necessarily about net absorption in their markets overall, because I think we're seeing tenants are going to be taking less space overall as work from home continues to evolve, or a hybrid continues to evolve in some capacity. If I had to own an office stock, BXP would be one I would own. We have owned it from time to time in our fund. Today, it is a bit more of a challenging outlook, but with a balanced risk reward in terms of that stock.
William is calling from London, Ontario. Fire ahead, William.
Good afternoon. Thank you for your past suggestions. I'm wondering if I should buy some more Canadian apartment REITs. Charles Adam Robert.
Canadian Apartment REIT, CAR.UN.
Yes, so Canadian Apartment REIT's the largest publicly traded apartment landlord across Canada. Very good operators. We've spent a lot of time with management recently, including touring some of their real estate out in Vancouver. As a result, the stock's actually done well. If you think about the dynamics of apartments across Canada, this is probably one of the best environments there have been. You got muted new supply. You have greater and greater demand every year as population growth continues. Canada is is one of the leading countries globally in terms of population growth, and we see immigration of 500,000 new Canadians coming to Canada every year, and they're going to look to apartments like the ones that Canadian Apartment REIT provides. As a result, the stock has done well, and it's the most expensive amongst its apartment peers, which is not a bad thing because it's done well, yet it still trades at call it a 5% discount to net asset value. As a result, if you're looking for names to own, I continue to hold on to that. You might find better value elsewhere, just in terms of names that provide a wider discount to NAV, and we can talk more about some of those names coming up.
Okay, we have an email from Sid. Sid wants to ask about another biggie in the sector, RioCan REIT. Ooh, those units down about 19% in the past year. What's the outlook for the distribution?
In terms of the distribution, I think it's very safe. And the simple answer is, I believe they used to pay 12 cents pre-COVID. They cut it down to 8 cents and have been growing it up to half a penny in the past little while now. They pay about 9 cents a month. They operate at a very comfortable distribution level. In contrast to someone was asking about Smart REIT earlier, Smart REIT never went through that exercise of cutting their distribution during the pandemic, and RioCan did. So I'm certainly not worried about the distribution. I think RioCan has set itself up well in terms of providing a longer-term same property net operating income growth of 3%. Seems pretty achievable given they just did 3.7% in the last quarter. And as soon as you put together the formula of population growth, limited new supply, limited bankruptcies in retail, offset by rising interest rates, I think the setup is pretty good for retail shopping centers generally across Canada. And so I think RioCan's in a good spot.
Okay, we're out of time already. Don't go away. We're going to get Andrew's top picks in real estate after this. First idea is Boardwalk REIT, the big Alberta landlord. Of course, they're in other parts of the country too.
Yes, Bloomberg had a great headline this morning. Soaring Canadian housing costs drive population boom in Alberta.
Right.
That really tells the story for Boardwalk. Boardwalk provides affordable housing for Canadians, and with a concentration called 70%, between Alberta and Saskatchewan, in their portfolio. What is great about their portfolio is that, notwithstanding the fact that they're able to get 9.4% rent increases on renewals or 15% rent increases on new leases, rents continue to be affordable for them, just like that article suggested. If you were to look at rent to income ratios for them, they're in that 24 to 30% range. Typically, you'd find in other parts of Canada, it's in the high 30% range. The stock trades at a wide discount to net asset value, and that net asset value continues to grow every quarter as they're able to generate these high top line numbers I mentioned. We think same property net operating income could be anywhere from 12.5% to 14% this year, and we wouldn't be surprised if we saw a similar number next year. I think that's a really great story to tell, whether or not we're going to recession or soft landing. I think this is a really easy story to understand when you have population growth, limited new supply, and pricing power.
Okay, we've got First Industrial Realty Trust, trades in New York. What are they all about? Are they warehouses?
They are warehouses in the top markets in the United States, really concentrated in 15 of the top markets in the United States. They operate around 65 million square feet of industrial warehouse. Outside of Dream Industrial, this is our best idea in industrial warehouse globally, because it trades at one of the highest discounts in net asset value, over 20%. 25% of its exposure is in Southern California. That's been a really strong industrial hub, though recently new supply has met some of that demand, and you're not seeing the same type of pricing power. We think that pendulum's going to turn beginning next year, because with inflation, we've seen construction costs increase tremendously, and hence new starts have really gone away. So you could paint a scenario beginning in the second half of 2024 where you're going to have heightened new demand for industrial. We talked about factors like onshoring and reshoring creating really great demand drivers at a time where there's no new buildings to meet that new supply, to meet that demand. And so we think First Industrial is really poised to take advantage of this at a time where, even if there isn't any further market rent growth, they can capture 40 to 50% uplifts in their expiring leases because of that mark to market that they've had in terms of leases that were signed many years ago at much lower rental rates. So we think this is a great stock to own, great setup into 2024. And if the discount persists, it could be one of those M&A takeouts that we've benefited from in our past 15 years.
Okay, and then finally, Chartwell Retirement Residences.
So Chartwell's been an interesting story. This is one of the largest operators of retirement homes across Canada. The retirement space has been a laggard in terms of its recovery on the operational side post-COVID. We hadn't seen occupancy really recover. It had bottomed, but we hadn't seen an occupancy recovery until this year. I think we've seen over 400 basis points of occupancy improvement at Chartwell's facilities, and that is really generating right down to the bottom line. Whereas there were questions before, could they sustain their distribution? I think it's obvious now that they can. And as occupancy levels get back to where they were prior to the pandemic, at a time where you now finally have that great demographic boom of seniors, of the baby boomers looking to move into this type of product, you could paint a scenario where cash flow growth could become material, and hence net asset value could be increasing. So it already trades at quite a wide discount to net asset value, and I think if you could see one of the higher cash flow growth stories out of real estate next year in Chartwell.
Sorry, why is it trading at a discount, would you say, Andrew?
It's top line versus bottom line. On the top line, we were slow to see recovery in terms of new residents. At the same time, expenses have been much higher in this business, attracting new labor and staffing, higher wage costs. You've seen margins become compressed. But as soon as you see occupancies go from what were the mid 70s to 80 to 85%, yet our expenses stay static, you're going to see margins improve, and that cash flow really go down to the bottom line. So the stock had underperformed because it was a bit of a show me story. Was there something broken in the business model? Were people reticent to move into retirement homes post-COVID? And I think they've shown over 2023 that the thesis is still intact.
Andrew, go big picture with us. If interest rates have peaked, that we're done with the increases, or nearly all of them, what sectors of real estate will do well over the next year, do you think? Could you point to one area of the real estate market?
Absolutely. I mean, lower interest costs are going to be a tailwind for everybody in real estate, but it really comes down to what are the real estate fundamentals? Where's demand exceeding supply? And we talked about apartments in Canada specifically, where there aren't any rent controls in Alberta. We've talked about industrial warehouse globally. We've talked about manufactured housing in the United States, and probably the best setup is for grocery-anchored shopping centers in Canada through a name like First Capital REIT, where it's defensive, but cash flow is going higher, and you have population growth. If you have interest costs coming down, that's going to be a tailwind to all these names and all these sectors.
And give us your take on retail. You talked about RioCan, and I think you said the distribution looks solid for now, but grocery reasonable, but other types of retail real estate, will it still be under pressure, do you think?
I think the pandemic proved the resiliency of necessity-based shopping centers. Yeah. And as well as if you have population growth and you have the dominant grocery shopping center, you're just going to see sales improve and hence rents improve. Enclosed retail malls, that's more challenging in the sense of we've seen a lot of bankruptcies. We've seen a more challenging environment to backfill some of those bankruptcies. You've had to go to more entertainment, restaurant uses, et cetera. And if you're in an environment where the consumer is going to be spending less, they're going to keep their capital, direct their capital towards more necessity goods, but perhaps spend less on general merchandise and clothing, et cetera. And that has to come at the sake of the mall.
Andrew, always great talking to you, and thanks very much indeed.
Thank you.
Andrew Moffs of Vision Capital. One of our favorite guests. It's great to get a specialty take, really drill into a sector there.